Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with Chris Vermeulen. How you doing today, Chris?
I'm great, Kirk. Thanks for having me on the show.
Good. Well, awesome to have you here. I'm excited to talk about this topic. We don't talk about it enough. So, Chris, before we begin, why don't you tell the listeners a little bit about your background?
Sure. Yeah. Long story short, I grew up in the country, just north of Toronto, up here in Canada, and never had TV, never had cable. So I always played outdoors and built and hunted and you name it. And eventually I went to Toronto to college, went for business. And that is where I got hooked on CNBC when I first got access to a TV. And that was when I really kind of got hooked into, oh my gosh, I want to get into the trading investing world. So I started trading, investing through college, and have been doing that ever since, 20, 25 plus years now. And during that process, I've done all kinds of different things. I've started my own healthcare product line, built a network across Canada, United States, sold the business, and big into real estate and multifamily, self-storage facility, invest in a lot of different type of startups and things like that. So I kind of got a full kind of gamut of things that I do. I like to diversify into a lot of only stuff that I find is fun and interesting and obviously highly profitable. But the stock market is my key. That's my passion. I grew up hooked on it at a young age, and I live it, I breathe it, I follow it, and that's where I focus a good chunk of my capital. And that's what I'm trying to share with others is there's a way to navigate these markets that I believe is a much safer, lower risk way, and a way that you can also generate higher consistent returns by navigating, reinvesting capital in a very different way than what most people do. So that's kind of it from a high level view of what I've done.
Awesome. Yeah, it's funny. You mentioned, I think you've been doing this for 25 years. That's around the time when I started too. And CNBC was addictive because the stock market was the big tech bubble, right?
Uh-huh.
Yeah, I'm not sure CNBC is what it used to be, but anyway, it's a good start. It's cool. So tell us a little about, so tell us a bit about your investing style. Let's just start there.
Right. So I went to business school because my whole plan was I wanted to become a CEO of a company. I always wanted to be a CEO when I was a kid. And I went to business school because I'm like, hey, I'm going to literally work on a factory floor, learn to sweep the warehouse and work my way up to the top. So I know how every nut and bolt works in a factory, and I want to run it and become very successful. Well, I ended up not wanting to work for somebody else, and I got out of school. And so when I got into the stock market, I decided to do the same style of thing. I went out, and over the years, I have tried trading, investing in all styles, from small cap stocks to options to Forex to day trading to scalping, ETFs, you name it. I've done all the different styles of trading and investing you can kind of do out there. And through that process, I found what works with my personality type, how often, how much I want to be stuck glued to a computer screen, which I don't like to be stuck to trading charts, and something that allows me to manage large amounts of money with lower risk. I'm done with the high volatile active trading. That was many, many years ago. And so the strategy that I do now focuses strictly on ETFs. We only focus on US ETFs. I use a hierarchy of assets to follow. And the hierarchy, as we move down the hierarchy list, that goes from volatile at the top to less and less volatile as we move down. And so as the markets get more chaotic, we're moving down this list to slower and slower moving assets, kind of what the opposite of what most other people tend to do. They tend to get crazy and try to make a lot of money during volatility. We actually step away and preserve our capital, because I believe preserving capital is number one goal. The last thing you want to do is get close to retirement or retire and then have things get wiped out. And it's a complete game changer. Right when you have the most money you've ever had, everything gets turned upside down. So the strategy I do, I don't believe in diversification for what when it comes to stock in the bond market. And you and I can touch on that, because I think a lot of people get very confused. They believe that diversifying in the stock market and stock and bonds is a very safe strategy. And maybe it is over the very, very long time, but it's really volatile. So we can kind of go into the nitty gritty of that, but I focus on ETFs. We move our capital into one asset class at a time through this hierarchy, and we only hold assets that are going up using technical analysis. And that's one thing I failed to mention. I used to trade fundamentals years and years ago, and you only have to be buying good stocks that are growing and making profits, only to watch their stock price fall. And so once I realized that, this was after the tech bubble burst, I'm like, okay, so fundamentals actually doesn't really work. And what I learned is, if the investment's not moving in our favor, if it's not moving up, we don't want to hold it at all. So that is when I pivoted and shifted to technical analysis, which means we follow price. It's not about timing the market. It's letting the market pick a direction, show us there's enough momentum behind a move or a wave, and then we just follow that trend. And when that trend comes to an end, we step off it and we look to a different asset starting a new trend. So we follow the markets. We trade only big liquid ETFs, and we're just trying to catch big waves that roll through the market every year. And a lot of times we are sitting in cash, 100% cash, or a huge chunk of our portfolio in cash, just collecting daily interest until there is a new asset that shows a high probability, high momentum move behind it.
So you went through a lot here, and I guess let me kind of pull it back a little bit. So you're in cash frequently, or is because you kind of went through a few different things. You talked about the hierarchy and then cash. So how do you look at your cash position? How do you use that in your portfolio as a lever?
Right. So the way that I use it is more or less, for example, say the stock market is in a strong uptrend, we'll be invested in the SP 500 or the NASDAQ, or potentially both. More or less, as we hit profit targets, as we reach certain levels, we start to trim off some of those, close some of that position, trim off the profits, move our protective stops up so that if the market's reversed, we don't turn a winner into a loser. That cash literally just gets moved over to, say, like another ETF, which is the symbol is BIL, BIL, and we can just collect daily interest on that money as we're waiting for a new opportunity to get in. So as we scale out, we're protecting capital. And then, of course, eventually the markets will stall out. They'll have some type of pullback and correction, and all of our money will move back into a cash position. And then what we'll do is, if the stock market's not in favor, we'll look to the next asset class to rotate that capital into. It could be the bond market, which the bond market hasn't been favorable for a long time, like TLT, but we can move into the US dollar index, which is a different asset class. And we can move into that. A nice thing about the dollar is it moves very slow. So typically, if the stock market is collapsing and volatility is through the roof, we can move to one of the slowest asset classes and just watch our money slowly climb, 0.5%, 1.5% here and there, and just keep growing, while the rest of the market is really chaotic. So we just kind of rotate into these different asset classes. And, the whole diversification thing, a lot of people will own multiple stocks and have different sectors and all these different things. And to me, if you own like, for example, if you own 100 different stocks, you're not really diversified when you're looking at asset classes. To me, the stock market is one asset. So it doesn't matter if you have 10 stocks or 100 stocks. I like to look at the stock market like it's the ocean. I'm a surfer, and the tide goes up and the tide goes down. It's the same with the stock market. If the tide is going down, it pretty much takes all boats with it, and most stocks go down. And I don't believe in holding on to that, an asset class like stocks in general, if their money is flowing out of the stock market as a whole. So what I look for, I picture myself as the surfer on the horizon, waiting for those sets of nice, clean, big waves that roll through the market. There's about 5 to 12 of them a year in different assets. And we just wait for one of those sets to roll through. And then we pick the asset that fits our hierarchy, that fits our comfort, our risk style. And then we can move on to that momentum wave that's rolling through the stock market. And the nice thing about catching a wave that shows a lot of power behind it, using technical analysis, intermarket analysis, how all the different assets are related, we also know when it's starting to run out of steam. So we know when to carve off that trend and be able to step back into cash or look for the next asset. So that's kind of how we navigate the market from a high level.
So do you short the market too? Because there are times where it makes sense to go short the market if we're having a bad cycle, if you will.
Yeah, so we will buy an inverse ETF. We never use any leverage, but the only time we'll use an inverse ETF on the indexes is during a a stage 4 decline. I don't know if you're familiar with Stan Weinstein's 4-stage analysis. There's a stage 1, which is a basing formation where the market's sideways. Stage 2 is a bull market phase. Stage 3 is a topping phase, which is what I think the markets are struggling with right now. And then a stage 4 is a major financial reset. It's like the tech bubble burst. It's like the 2008. And I believe one of those could be coming around the corner, which is why it's so important, I think, for people to be able to protect their capital in case this happens. And so when we hit a stage 4 decline, which is very rare, we will move into an inverse ETF and catch obviously some of the downdrafts, because in that type of market environment, the market's naturally falling. And so if the tide's going down, we want to take advantage of that. But they're few and far between. There's usually only a few trade opportunities in there during that opportunity, during a bear market phase.
Nice. So you mentioned earlier about fundamentals. How do fundamentals come in? Because you and I have probably similar amount of time experience in the market, and things have changed during that period where fundamentals really just stopped working. So how do fundamentals come into your analysis of your investing, especially in an environment like this?
Like, they don't come in at all. I haven't focused on fundamental analysis in a decade and change. I mean, a long time. So I really could care less have the strength of a company anymore. It really comes down to, following price. If an asset's going up, I don't care if it's a company going out of business, yet everybody's piling in, and that asset class is taking off. Like, for example, this year, the stock market really, the tech sector is hitting new all-time highs. We're seeing the markets come back with a vengeance kind of this year, but it's really just tech driven. If you look at the small cap, like the Russell 2000 index, or look at the majority of sectors, they have sold off. They're in downtrends. They are struggling. The majority of stocks are down. It's masked by just big techs kind of doing all the heavy weight. So, I mean, we really just have to be very cautious, because this market is not strong. And the fundamentals, to me, don't really, they're not good. They can lead, they could lag. They're just not an accurate tool to identify. They won't tell you if the stock price should be going up or down. It's just telling you what the company is earning. But with accounting and all those practices, it really doesn't matter. It's all about, as an investor, we just want to make money. And so we just move to an asset that's moving up or down and take advantage of that trend.
So if I look at if you're looking at risk management, right, and you kind of talked about your hierarchy, I'm really kind of interested to hear more about that. But if you're looking at risk management, it all sounds great. I mean, technical traders always talk about how, it's easy, you just get in, get out. But I think for most people, they don't understand how to do that. So maybe you can kind of talk a little bit about how that works and how you're able to manage risk in your way, which is different than the buy and hold crowd.
Yeah. So managing risk is by far the hardest part. I sell, I've seen many different things on how to do risk management, and no one has interest in learning how to manage risk. So unfortunately, it's one of the most important things to being successful as an investor. And through your life, you have to manage risk across anything that you own, because it only takes one bad slip up and you can wipe out your wealth very quickly. It could be a lawsuit. It could be a bad investment that just backfired. Risk is the number one. So long story short is, I grew up more or less kind of learning risk through my family. My family ended up having to go through a bankruptcy, and I saw how it affected my dad and his health. He almost died because of the extreme. And so I was very paranoid at a young age, in my 20s, that I do not want to lose all my money. I've seen how you can go from the top to the bottom and it can affect your health. I also got my pilot's license when I was 16. And I remember doing my solo flight, and it all came down to walking through that checklist, having systems in place, having rules that you believe in, that you've done 1,000 times over, and that all you have to do is just try to tune out your emotions and follow that. And risk management comes down to having strategies, systems in place. Things need to be systemized. If you're shooting from the hip, if you're trading because you like something or you're scared of something, that investment is likely going to backfire on you. So it really comes down to understanding how much capital to put into a position, knowing, through technical analysis, we can find out statistically how often a particular asset will move in a direction before it moves back. I use a lot of different types of analysis, from statistical to cycles. I use money flows through the New York Stock Exchange. We use intermarket analysis because every asset is connected in some way. If the stock market is going down, all that money is going somewhere else to a different asset. Could be bonds, could be currency, could be real estate, could be whatever. So the key is having systems in place that you can get a gauge on how strong is this move coming in to a new asset or something. And if it meets the criteria, we can get onto it. But then you have to follow rules that manage those positions, meaning you have to take partial profits if you want to reduce and manage risk. And the thing is, when you manage risk, you're not going to hit grand slams. Grand slams are when you put a huge money in and you catch a huge move and you let it run. And that's what so many people think. They have this false expectation that they should be able to hammer out huge returns from the stock market as an investor. But that's not the reality of things. To me, it's all about hitting a bunch of 1, 2, 3, 4% moves and scaling out as we hit targets, like a 3% move or an 8% move or 15% move in an asset like the indexes, and moving that other portion to cash and just collecting interest on the cash while a particular move is starting to run out of steam, because it allows us to reload and move into a fresh new asset after that. So the whole risk side can be very complex, but I do try to keep it really simple in terms of, we move our money in, we use technical analysis to identify trends. So we can use moving averages and cycles, money flows, and we can say, okay, this has got a very strong trend. There's a lot of money moving behind this. This is kind of a freight train. And we want to move on to that once that trend is clearly to the upside. And then eventually that asset will roll over, and our technicals will say, okay, short-term trends breaking down, intermediate trends breaking down. Money is now starting to flow out of this asset class as a whole. And it's time for us to move on, close our position, and go. And we'll probably see where that money is flowing within our hierarchy and where we want to go to put that money back to work. So it's kind of it from a high level.
Okay. Yeah, that makes a lot of sense. So, are there areas that you stay away from? Like, are there asset classes or asset types that you do or don't, more accurately, don't use in your investing styles?
Yeah, now I don't really trade individual stocks anymore. I just like to manage money as a whole, like my whole portfolio. I don't want to get into individual stocks that pop and drop. I don't trade Bitcoin or cryptos at all. I think there's probably some amazing opportunities there, but it's just, I don't know. I don't have big interest in it. It is a way too fast moving market. Is pure speculative. It's moving 10, 20% a day at times. That's, to me, is not how you manage. I mean, you have to actively trade that stuff or just ride the roller coaster. More or less, I love the stock market. I like bonds. I like the US dollar index. I like real estate. Those are kind of the core assets that I like to just rotate money through. And they all have big cycles that are at play. And so, you could go 4 or 5 years or longer with maybe stocks and bonds doing exceptionally well. And then flip side, we could have like a wave of 3 or 4 or 5 years that real estate is where the money should be going, or a currency type of play. It really just depends on the markets.
Yeah, I know. I'm just curious on the crypto. We didn't get to that yet, but I'm curious on that, because I would think, I mean, traders love that, not because of the move, but because of the risk to reward payoff for it, right? I mean, it's an asymmetric risk trade, which is like the holy grail of investing. So is that, I guess you don't look at it that way.
No, I mean, so what I like about the strategy that I do, which I call asset reinvesting, which is right stuck between the buy and hold and the active trader, is it doesn't require a lot of trades. I mean, we have one ETF open in our portfolio at a time. If we're into the equities market, we'll have half of our portfolio in the SP 500, half of it in the NASDAQ, if both of those give us a signal to invest in. But we're in one ETF at a time, which is super easy. I don't want to have to trade something that is popping and dropping. I've traded enough. I have other things on the go. I don't need to be actively trading stuff that's moving 20%. For example, if Bitcoin, which moves 15 to 20% frequently in a day or two, you can't go dumping in a huge amount of money. I'm not going to lose 20% in a blink of an eye because of some another hack or something like that. So to me, it's more of a lotto ticket type of play. I know people believe in crypto, and I think it's got its place. I think it's an asset, but it's not something I want to just play with. I haven't spent the time to learn it. I don't invest in things I don't know inside and out that I can feel in my bones. And so that's why I just don't touch it. I really just want to put all my money to work in the lowest risk way with the least amount of trades possible. I'm trying to move away from active trading, period. I haven't active traded in a long, long time, but I want to be more aggressive than the buy and hold, because I believe there's, the two extremes that most people do is the buy and hold, which to me is like doing nothing. You're just riding that roller coaster out. And then you got the active traders. Both of them are volatile. If you do anything to the extreme, it carries a lot of risk. And if you're an active trader, there's all kinds of studies that show if you've traded for 300 days or more, even during a bull market, about 97% of people lose money. It is absolutely phenomenal how emotions take over. And we've done it. We did a survey recently with about 5,000 traders and investors. And the number one thing was always emotions took over, and they would be trading off emotions. So, what I do is kind of right in the middle. I only have 5 to 12 repositions within the portfolio a year, which for a passive investor who doesn't really do anything seems like a lot. But if you're an active trader, you're like, well, that's not enough trades. I won't make any money. So I do something that's definitely right stuck in the middle that is, outside of the two extremes.
Interesting. So what's your average hold time per trade?
Over the last year and a half, it's only been about 3 to 4 weeks or so, just because it's been 2022 was a sell-off with lots of waves. But typically they're about 40 days, the holding time on the average trade, if you kind of net it out over the past 10, 15 years. Some of them can last 8 months though. So some of these, it really depends on the market. As you know, nobody knows how the market's going to move. And we just follow the trends at play. But that's, yeah.
Okay, cool. Yeah, I mean, it seems like there's a bit of trend following in there, but maybe not the longer term, like midterm trend following. Is that accurate?
Yeah. Yeah. It's kind of like swing trading / position trading. Like, we're not catching the major bull and bear market trends. We're kind of catching the waves within that, because we don't want to ride out those 20% corrections along the way, which happen quite often.
So explain if I kind of break it apart for listeners, there's kind of the short-term trading, there's swing trading, we'll use that moniker, and then there's kind of the longer-term trend following. How would you differentiate those from normal traders, right? Because you're saying, well, all these people, 97% lose money. Okay, well, there's obviously a lot of people out there that are doing this for the action. Right. It's just another casino for them. So it's not really investing or trading. It's just casino action legally.
Yeah.
So I kind of don't include those people because some people just need that. And it's more of an addiction than investing. But if you look at general traders who actually know what they're doing, how would you characterize kind of risk to reward for each of those three types?
Yeah, I mean, if you're a really active trader, say you're day trading or momentum trading, so you're trading multiple times a week, the risk to me is very, very high. When you're doing a short-term strategy, that means you're hunting, you're looking for trades because you're trading to make a living, trading to grow your account. And when you have to find a trade, you're probably going to find them, whether they're there or not. So you're going to start to see things or think you see trade setups. You're going to force yourself into plays because you just need to trade today because you need to make some money. So short-term trading adds this added pressure to it typically. And the more you trade, the more emotions you have. So short-term traders, very emotional. They can be very emotional, and they're usually chasing extremes in the market. So that's kind of like that day trading, momentum trading. And then you got swing traders, which try to look to get into trades that last a week to several weeks, which is a really nice sweet spot in the market. That's somewhat what my strategy is. I'm kind of, a couple of weeks to several months. Swing trading to me was always my favorite because it's active. So you do get that fix of trading because everybody trading is highly addicting. It is a rush. But you can catch really nice moves in the market. I think a lot of swing traders, though, gravitate to really high momentum, fast moving assets like cryptos and things like that. And if you don't have risk management, and this is the same with active short-term active trading, if you don't have active risk management, you're going to take a lot more losses. The more you trade, the more you're going to lose. And that's what most stats show. And it really comes down to they don't have systems in place and they can't get out of a winner or trim out of a winner. I see this all the time. People we'll be in a trade, we'll be taking partial profits. People will be like, well, why do we want to get out? It's making money. I'm like, well, because, a list of reasons we need to scale out, blah, 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 blah. But they're like, well, I'm not going to get out because I like it. And, it's going up. Why would we get out of it? And then the flip side, people start to take a loss. They're like, well, I'm going to hold on to it a little bit longer. I'll let it rebound and I'll get out. And eventually it just keeps going down. So emotions are the biggest part. And swing traders are catching really big swings in the markets, and it can be highly emotional. And it's very active. And then you get into kind of like position trading, which is trades that can last several months. Definitely much more laid back. You're looking more for bigger trends in the markets. You've got more wiggle room. You're probably, what I do is I trade slower moving assets. I like the stock indexes. And you can move large amounts of capital in, and we're playing these moves that are kind of, it's like slow motion. To me, it's like slow motion trading versus, people who are trading for high volatility things. So it's almost like we're trading the markets on slow motion mode with this position trading. And to me, that is a sweet spot in the market. If you can identify if big money is flowing into a certain asset and there's a lot of momentum behind it, it is great to get onto those. They can last months. That is a nice, to me, conservative play. And you can trade those usually with ETFs. And then you got the long-term investors, kind of just the buy and hold. You're guaranteed to have the roller coaster ride just because you're holding stocks and bonds, no matter what they do. Even though you've got a mix, they are very volatile. You can still have big drawdowns. So it really comes down to finding that sweet spot and what fits your personality type. If you're very busy, I like the position trading because I can look at the screen in the morning and be like, okay, we're still at least 4 or 5 days or 2 weeks away from the next trade, like a new entry, or we're still days away from a potential profit target or a stop. And I'm done. I can go about doing other things. So it really comes down to how active somebody wants to manage their money. And if you have a lot of things on the go, then you probably don't want to be glued to a screen watching the news and going through that emotional roller coaster.
Yeah, that makes sense. So let me ask you this, because this comment comes up a lot. So you're obviously trading is a big part of what you do, but you also like running businesses and investing. So why trading? There's so many other opportunities out there to run businesses and other things. Like what about trading is better than running a business? Or if you're doing both, why do both? Why not just do one really, really, really well?
Yeah, well, trading is also a business. I run a newsletter. I share my research with others. So that is, it is a business, but it's also my passion. And so all the stuff that I do when it comes to stocks, bonds, and currencies, I'm really just managing my own money. I've designed the strategy to manage my wealth, be able to actively trade the stock, bond, currency chunk of my capital, and I just share that with others. I need to manage my money anyway, so why not share it with others? I love what I do. I love the people I work with. And so it's the best of both worlds. I do what I love, and I'm helping others and have a really good community of individual investors where we do the same things together. So that's why I do it. And I have many other businesses as well, but again, everything is systemized. Technical traders, like what I do is systemized. I have my trading software, my strategies run automated. It'll email me. It'll tell me when we have a new trade alert. I can confirm it. I can manually put in the trade the next day because it's all end of day signals. My other businesses run without me. So I'm all about trying to have multiple streams of income, passive income, and being able to spend the time on the ones that I really like. And that's where the trading investing is not only do I need to do it? But I love it, and it can be a rush. Even just being in positions is a rush. It fixes a lot. It checks off a lot of those boxes altogether.
That's great. Well, cool. Well, as we get close to wrapping it up here, final thoughts from you, Chris, and what do you think our listeners need to know that we haven't really talked about today?
It's a good question. I mean, I think investors really just need to, think about how potentially their stock and bond portfolios are invested. I think we could be coming into learn about the 4 stages. You can look those up online. If you know what stage we're in, then you'll understand why the markets and your portfolios have been performing the way they are. And if we are going into a major financial reset, you should look into finding a way to protect that capital, because we could be going into a 2008 or a 2001, a big unwinding in the markets, including real estate. And it's important to have that side figured out and have some type of protection plan to minimize risk or try to eliminate most of it altogether if it does happen. And I think just understanding the stages of the markets is really important. A lot of people don't step back and look at the big picture of these stages. There's a lot of new investors out there that have never been through the 2008 crisis. They don't know what to expect. They don't realize the turmoil, the stress that it can bring. So I think we're at a time right now. We've just gone through a bubble in almost every asset class. Everybody's got the most wealth they've ever had. Now is not the time to lose it. We don't want to give it all back. Right after times are good, usually you have tough times. And that's what could be on the horizon. Whether it is or not, you need to have plans in place, manage that risk.
Awesome. Well, Chris, I really appreciate you coming on the show. Where can people find more about you?
Sure. Yeah. They can go to my website, thetechnicaltraders.com. So 3 words. And I've got the infographics there on the 4 stages that they can download, and they can learn more about how the markets move and what to expect going forward.
Awesome. Well, Chris, once again, appreciate you coming on the show, and appreciate you sharing your wisdom with us, and we'll have you back on in the future.
Thanks, Kirk. It's a pleasure. Take care.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Chris. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. Doing great. Lovely February day here. And we also have our...
Look, it's raining in San Francisco, so we sort of have some of your pain.
No, you don't. No, you don't. I have a backyard ice rink and it's 50 degrees out and the ice is still there and I can't skate on it. And it's just tempting
Oh.
me. Just try me. Just step on it. It's okay. Actually, I was on it last night and it was just like potholes and divots all over the place. It was terrible. But it was Christmas a few weeks ago when we got to skate on it. So very
Nice.
exciting.
Nice.
We also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today? Good to be here.
Doing great. Doing great. Well, let's dive right in. So, Megan, what were some of your thoughts from the interview?
Yeah. I mean, I think a couple things, what really struck me is he is an investor, knows who he is. So he said two things that really stuck out at me. The first thing was he wanted to be a CEO, right? But then decided he didn't want to work for anyone. And I thought that was really interesting because I think it caused a lot of self-reflection. And I think that when you are investing and deciding who you want to be in the capital markets, you really have to decide who you want to be and who you want to follow. You can listen to lots of different schools of thought, but knowing who you are is important. So it brings me to the second thing that he talked about, which is he doesn't believe in diversification. So as soon as I heard that, I'm like, well, I know myself as an investor and as someone who runs a firm, I do believe in diversification. It didn't mean I wasn't interested in what he had to say. I thought he was interesting. I thought his approach was unique. But I also knew that it was not going to be a style that worked for me just because I have different beliefs. And so I think this is really important because, we're still here at the beginning of the year. I mean, I know I can't say Happy New Year. Larry David would come after me, but I think this is always a good time of the year to take out your investment policy statement and go through the mandate for your portfolio and really reiterate who you are as an investor, right? And, it could be you like diversified investments. It could be you like doing more of active trading, right? But knowing who you are will help drive a better sort of sense of satisfaction over what happens with your portfolio.
Yeah, the comment you made is I think is so true about him not wanting to work for anybody else, and this is one of the things, it's funny, we haven't talked about this in the show for like over 6 months, but we talked about it a lot before, which is knowing your investor psychology, right? And knowing who you are is such an important part about investing. And most people think they're Warren Buffett and they can't invest like Warren Buffett. They invest like they're going to the casino. And those are very different styles. And if you don't know that about yourself, and that's why, we brought on Jonathan Dio a few times to talk about mindfulness because it's so important. It's just understanding yourself, like knowing, like don't try to be someone you're not. You're going to have more success being somebody you are than trying to be like a Warren Buffett. There's a reason there's only one, right? And well, I guess two if you include Charlie Munger, but there's a reason.
There's only one left.
Now there's only one. Yes. RIP. But it's interesting that most people they're interested in like the action, like, hey, I can day trade and make 1,000% return a day. It's like, well, no, you can't. But I get the allure of wanting to do that. But if you're Warren Buffett, you're going to destroy your portfolio because your psychology is not aligned with that. You would almost have to retrain yourself to become that. As he said, he can't work. He realized he couldn't work for somebody else. I had that same realization too. I always knew that I needed to run my own shop. And it's not because I can do it better than everybody else. It's because that's the way I'm wired. I'm wired to do that. It's just like investors who are do-it-yourselfers versus investors who want help from an advisor. Some investors just want to do it themselves. And even if they stink at investing, they're still going to do it themselves. It's just how they're wired. Some investors are really smart, and I work with some of them. They could run their own portfolios. They're not dummies, but they just don't have the time or the interest or the inclination, whatever it is, right? So they use an advisor. Everyone's different, and understanding yourself is so important when it comes to investing. Because if you're trying to be someone you're not, just like in life, you're going to fail. So anyway, so Phil, what were some of your takeaways?
So I'm just going to follow up on a few of the things that the two of you said. So I came to the same realization without going to my career with the intent to ever have my own business. And then finally, I did get to that point. And now I tell people that I got tired of working for idiots. So I decided to be the idiot and be the one that was running the firm. And it was really the best decision I ever made. It fit me very well. We talk about different investment styles. So I've tried a lot of different things too. I remember in the 90s, I wrote for the Motley Fool when they had online portfolios, and I took a 1 day, and that was all I could stomach of it, day trading course. Listening to the guy talk about how he spent his day just staring at his computer screen all day long and not being able to get up, I knew that was not anything I could ever do. I went and got my CFA, and I was an analyst, and I got a call. I would get calls from people in the media all the time asking for my opinions about stocks, about oil prices, and everything else. And one day, one of the guys that would call me all the time called to ask me about some charts. I said, I don't do technical analysis. And he was shocked because he thought that all analysts did that. It was part of the CFA curriculum. I understand enough about it to be dangerous, but it's not something that works for me. So it's really true. And so not only do you have to find something that works for you, I also think what's really important is once you do, have a process. Like having a process that you stick to it's so important. Michael Mauboussin writes a lot about behavioral investing and the psychology of investing and things like that. And he has this grid that I have shared in my blog several times. Talks about we can make a good decision, we can have a good outcome or a bad outcome. We can make a bad decision and still have a good outcome or a bad outcome, right? So what you want is when you have a good outcome and a good decision. But the important thing about that overall is that we have to have a good process, because if the process isn't good, we never know why we were right or why we were wrong. And if we don't follow the same process, it gets really hard to have any kind of results that you can depend on or count on or even be able to rely on it in any way, shape, or form, because we just don't know what the outcomes, what caused our result if we don't have a process that we follow consistently. So you find what works for you, and don't go jumping around trying to follow the latest trend or whatever your friend's talking about. Do what's right for you.
Yeah, it's interesting. We had Annie Duke on the show a while ago. We talked really about just the psychology of thinking, like making good decisions. And one of the topics that came up, which she talked about in her book, is just what you said, Phil. It's the quality of the decision is not necessarily tied to the quality of the outcome. Right. So you could make a very high quality decision and the outcome could be crap. Right. You could say, this is a quality decision, I'm going to go this route. And you could be wrong. Right. Like you look at all the factors, all lines up, and then the stock, goes through the floor. And you're like, oh, well, was it a bad decision? No, the outcome just wasn't what you thought. And in part because you can't predict the future. Right. We can't know what's going to happen. I think they used I think she used the example in her book of Pete Carroll, I think, in the Super Bowl, and how he made a decision. I think it was to go for 2 points instead of 1, and everything lined up. It was a good decision, and it didn't work out for him. And everybody was like, "Oh, it was a bad decision." Like, no, it wasn't a bad decision, just a bad outcome. And disconnecting the two, it can be really hard. A lot of people look at it and they say, "All right, I'm going to make this decision and I was wrong. Okay, that was bad. I did that bad." No, like you need to disconnect the two, because if you make good decisions over the long run, your outcome will be in your favor, right? If you just guess, then the outcome is going to be random, right? But I think that a lot of people don't understand the disconnect between quality of decision and the quality outcome. And I think if you take one thing away from today, take that away, because that's something that I don't even hear people talking about. I mean, how much have you heard this, Megan? I mean, this kind of discussion, like we hear a lot in the investing world, but I don't hear that very much.
Don't hear that about.
I mean, just
sorry.
like the psychology of this quality decision and quality of outcome. Like most people are just judged by their outcomes, not by the quality of their decisions.
Yeah, I think it's difficult, right? I mean, like what I would analogize it to and what we do is when I'm working with clients to construct a retirement strategy, I always use the term garbage in, garbage out, right? So that any work that we're doing in constructing a plan, we have to make sure the assumptions have grounding in truth and that the actual output is correct. What I have found over the course of my career is so many firms do things like retirement cash flows, right? You guys probably see this all the time, right? And sometimes I'll get ones that they had run previously and they weren't grounded in the right assumptions. So why I bring this up is, sometimes I find that, the psychology of getting a client to really think through their true financial planning assumptions, at times it's harder to do it because so many people have not put a lot of work into getting the assumptions right the first time. I can't explain, like, I don't know if I'm explaining myself the right way, but I just think I think sometimes the industry does a lot of analysis and everybody assumes all the analysis is the same quality. And I think that that's not always the case.
Well, that's very true. There's plenty of analysis out there, and everyone's got a different opinion. So you could throw a rock and hit a different opinion everywhere you stand. So, but let's talk about something, because this is actually something I was interested in in talking with Chris. Is Chris is more of a technical trader, and certainly that is a style that some people use, and this topic, which I actually want to get somebody to come on and talk about this at some point, but the topic is like tactical investing or tactical strategies. And every time I bring it up, I just get that, oh, that's snake oil, or oh, that's reading the tea leaves, or there's just this disdain for tactical investing. Like, I know you look at a lot of different managers, but like, do you have an opinion on that? Because I'm just always curious to get people's opinion on it. Because when it comes to technical, in a sense, it's kind of tactical in a way.
First of all, so I'm very fortunate. I have a chief investment strategist who runs all of our due diligence. I think the thing is, you're trying to, I think if you believe in diversification and you are trying to use the portfolio as a way to hit certain financial planning goals, I think tactical trading is a challenge, right? Because what you're trying to provide clients at times is consistency in the market. And when you study things like luck and return and performance, all of that comes back to being consistent, which is sort of contrary to tactical trading, which is, there is, you're approaching things differently all the time. Over the course of my career, I have worked with firms where they will do like a 2 to 3% layering to a tactical fund. I will tell you, in looking at those portfolios, their batting average wasn't that great. But what it did, and this is what's interesting about psychology, is clients liked it because clients always want to feel that they're being tactical, right? They want to feel like they're into where the market's going because they're outthinking the market. So they tend to like those funds. But I think from a performance standpoint, they're a lot harder to get consistent return out of. So I'm not a big tactical trading person. But it's not that I don't believe that it can't be successful. It just doesn't mesh with my investment philosophy. But Kirk, I think you have a lot more comfort with it, right? I would be more curious to hear what you have found. And maybe when I say I feel it's not consistent, you might tell me it is incredibly consistent. So what is your experience like with that?
What I find about tactical is interesting is there's a very small number of managers that actually do it, right? In comparison, there's a much smaller number of managers that are actually tactical. That's one thing. Another thing is tactical is kind of like the catch-all. Like, it doesn't fit into a buy and hold strategy of small cap value or whatever the Morningstar category that they put you in. It doesn't really fit into a category. So it's kind of like a catch-all. So there's so many different strategies out there, and how do you compare them, right? It's like comparing apples to oranges. Like, well, this one is, it's long short, and this one is, technical only, or what, I'm not coming up with good examples, but like each one is different in their own way. And like, how do you compare one to the other? It's like saying, oh, the hedge fund index, and comparing it to the hedge fund index. It's like, well, each hedge fund's different. Like, they're not all the same. Like, if you're talking about long short, depending on the long short, I mean, there's M&A, there's arbitrage, like there's all these different styles. And if you just dump them all into the tactical buckets, like, how do you compare them? Like, there's no reasonable way to compare those managers because they're very different, and there's not enough managers out there to compare. So there might be 3 managers that have one thing that they do. Like, how do you compare them? Like, against each other? Like, it's just, so in that way, it's kind of a weird category. I will say that from your point is very valid. Like people want to be tactical. They want to feel like things are changing. And we do that as our style. Like that's part of our style is we have a tactical approach to investing. But the way that we do it is more the way I kind of phrase it is this, is when you're investing, you could have a fixed mindset or you can have like a growth mindset.
Mhm.
The fixed mindset is I do this, I only do this, I fit in this box, I don't look outside the box, there's nothing outside there, I just do this. Which, if you're a mega cap growth manager, you've done great in the last 15 years. But if you're like a value manager or a small cap value or even small cap anything, in the last 10 years, you stunk. Well, it's not your fault because you're just operating this box. But at some point, you got to think like, well, am I in the wrong box? So I look at the tactical approaches. In a way, it's kind of like what most advisors do, which is diversification. But I do it in a way that's more thoughtful. It's not just buy and hold or buy and forget. It's how do I look at this problem of performance differently? Because if you're an indexer, you're getting the performance of the index. And if you're okay with that, then that's great, right? If you're 25, 35 years old, it's probably okay. But if you're 65, you're getting ready to retire and you're an indexer, you're setting yourself up for failure. So we use, not get too much in the weeds, because I want to get Phil's opinion here too. But, we look at things from a risk management perspective. How can we manage risk better? Because most people look at it and say, what style are you? What's this? It's like, I don't care what style it is. I'm looking at it and saying, how can I manage risk better? And if we're in a bull market, that's different than if we're in a bear market, right? Or if we're in a sideways market. There's different strategies for different types of markets. And if you don't open up your thinking to the fact that, like, for example, I'll give you a good example. If you're a buy and hold investor, overall, over 100 years, you did well. But there are periods in time, pockets in that 100 years where buy and hold is not your friend. Pretty much the late 60s till the early 80s, it was not your friend. The markets basically went sideways for about 14 years. Not your friend. If you look at 2000 to 2013, went sideways for 13 years. The market was not your friend if you're buy and hold. You lost 13 years of time. That's 13 years of compounding you're not getting back. Now, if you had invested in bonds in early 2000s, you would have doubled your money in that same period. So is the let me put all my money in a box and forget about it the best approach? I don't know. But if you're not thoughtful about that question, then you're missing a big key to investing, right? And if you're the way I think about it is most investors, they see the box and they say, these are all my options in this box. Like, this is all I have to choose from. I got 9 Morningstar boxes and I got to fill them in here. And then I got a fixed income box. They got their 9 fixed income boxes, and somehow international fits in there. Not really, but it somehow fits in there. So people put themselves in a box and they say, these are my choices. When in reality, those aren't your choices. Those are a handful of choices. You could also invest in real estate, private mortgages, private companies. You can invest in racehorses. You can invest in like whatever, the world's your oyster. You can invest in whatever you want. So why are people restricting themselves to those choices? Well, it's because A, they don't know any better. B, it's because Wall Street tells them those are their only choices. And C, you've got to really be into it. Like if you're investing in real estate, you're a real estate investor. That's not passive. That's an active activity, unless you're in a REIT or something like that. So I think some of it, like self-directed IRA investing, and I'll punt to Phil because I don't want to take up too much time. But self-directed IRA investing, 4% of retirement accounts are invested in alternatives. 4%. Mm-hmm. That's tiny. And you know why? It's because fewer than 10% of retirement investors actually are even aware that you can invest outside of the stock market. 10%, that's it. 90% of the public isn't even aware it's possible. So it's not that they can't. I've talked to a lot of real estate investors that will not put money into a 401k because that's money they can't put into real estate. You can, but nobody's told them that. So they have no retirement account. They have real estate, which is fine, right? It's they got some tax benefits, but they would put the real estate in a 401k if they knew they could, but no one's told them that. So I think a lot of investing is about not knowing, what your choices are. So when it comes to tactical, like there's so many things you could do, right? You could be long, you could be short, you could be focused on what if we have a sideways market, you could manage risk different. I mean, that was originally why hedge funds were attractive in the late 90s, is because, hey, you could have your cake and eat it too. You make money when it goes up, when it goes down, you have some short positions, like all that was attractive. And now it's all got watered down. But regardless, like there's more options out there that people aren't aware of. So I look at tactical as what is the best approach given the market conditions. And I'll give one example and I'll give it to Phil. Let's say you're a covered call seller, right? You're just doing covered calls to generate income. Well, I know in 2017 we were doing that. 2017 the premiums were razor thin and it didn't make sense to sell covered calls because you weren't getting paid for the risk. So we stopped selling covered calls and we started buying calls because they were so darn cheap. I was like, this is a no-brainer. Let's buy the calls because they're so cheap. It's hard not to make money when you're buying cheap calls like a year out. So that's an example of adapting to market conditions. But if I kept selling covered calls, it would have just been taking a lot of risk with no reward. And why bother do that? Unless you're in your box, right? And if you're in your box, you have no choice. So what are your thoughts, Phil?
So it's interesting as I'm listening to you talk, I tell myself, I don't really invest tactically. When it comes to the stock market, I really don't. I look at, here's what my allocation is, and I want to make sure that I have investments that fit within that allocation. I'll rebalance. But when I look at the fixed income side of the market, if I'm really honest, there is some tactical steps that I'm taking, because when we had such depressed interest rates, and the biggest risk was that interest rates would start to rise, and when interest rates go up, bond prices go down. The longest duration bonds, the longest term bonds that I had was midterm. I didn't have anything long-term because I knew that there was a lot of risk with that. So that is actually a tactical decision, because I avoided part of the fixed income market because I was concerned, like, to me, the risk didn't justify taking a position in it. Now we've had interest rates rise, and I've changed some in terms of how I look at fixed income, because I like where the rates are, and I find that there's relatively safe treasury bonds and things like that paying a reasonable return. Like if I look at fixed income and I say that I can get 4 to 4, 5, 6% return on a safe security, I'm okay with that, because I feel like that's a good result. I still don't want to go too long, because holding long-term bonds, they say, well, you hold it till maturity, but if a bond is a 30-year bond and you got to hold it till maturity, that's an awful long time. And a lot of things are going to happen along the way, but you can go for, again, that medium term. So there is sometimes, to me, at least on the fixed income side, where tactical is entering into what I'm doing. I just don't always think about it that way, because to me, it's like, this is what the market says. I know where the risk is. This is what I should do.
Yeah, I think you make a great point, Phil, because there are different degrees of being tactical, right? Because even if you're an allocator, even if you're just like, I allocate to different, asset classes, there's an element of tactical there as well. Unless I just put it there and leave it, or I rebalance and I never think about it. Like, that's not tactical. But if you're making decisions, like you said, Phil, like changing the bond allocation because it doesn't make sense, that is tactical. Yeah. Like, good example, like I don't know, it was probably, except up till 2022, like we didn't have any bonds in the portfolio. Everyone's like, well, you need bonds. Like, what are you doing? Like, well, bonds are paying 0%. Why am I investing in a bond? Like, that's stupid, right? There's a ton of risk, no reward. Why would you invest in bonds? We're like, well, because you have to have bonds. Like, there's this lack of thinking that goes on of like, because someone told me 20 years ago I had to do it, and I've never bothered to think about the fact that it doesn't make sense anymore. And so I think, there are plenty of people who invest in bonds throughout that. And there were some bonds you can invest in. So I don't want to chastise people who had bonds. But if you were buying like 20-year bonds because some formula said you had to have it 5 years ago, then, I mean, what are you doing? Right? Why these banks are failing, because they had 30-year bonds paying 1%, and now they're paying 5%, and the banks are underwater. And so but it's a good point because there are degrees of being tactical. The question I have for you as a follow-up though, Phil, before we go back to Megan, is you talked about the importance of process. So how do you bake that, your kind of thinking of like, well, this actually doesn't make sense at all, I need to change this. How do you bake that into a process? You know, because what you probably looked at it and said, wow, this doesn't make sense, let me do this. But the having a process is important because how do you make that decision about how to tactically change things in the portfolio?
I don't know that it's a really good question. And I don't know that it's a formal process that leads me to that conclusion. It's more, I'm constantly reading, I'm constantly looking at what's going on. I'm constantly analyzing and thinking about things. And the realization comes to me that something needs to change. Maybe that makes it take longer. So it's not like I'm trying to time, and it's not like I'm being overly tactical. It's just that to me, circumstances can change based upon the environment. And I want to react to that, not be overreactive, right? But it's just really, my work tells me, the work that I've done and the research that I've done tells me that this doesn't make sense. You know, I started my firm in 2017, 2018. And at that time, I made the decision that I didn't want to go too far out on bonds. And then when I saw interest rates go up, I'm like, well, the environment's changed a lot. So there was a significant change. Like, that's what really led me to it. Is I looked and I saw an external change that was large, right? To go from a 0% rate environment to one where 1-year bonds are paying 5%, that's a big change. And so seeing that was what did it. There was a big change. So I think what happened in the environment was what sparked it.
Yeah, no, that's good. And I think you kind of raised an interesting point, which is, you know, there's a line somewhere that you have to draw, and sometimes it's obvious, but most times it's not. Most times it's murky. You're like, I think it's like use Bitcoin as an example, and it's just an example, but because the moves are so extreme, it's easy to use this as an example. So it's like you look at the end of 22, right, when it bottomed out, and it's like, is that a good time to buy? In hindsight, it was, but you could have been like, well, it could keep going, you know, like you don't know where the bottom is. And just like, you know, when it tops out, it's like, where's the top? Is it a good time to sell? I don't know. Maybe not, you know, like bonds the same way. Like there was this thinking that when bonds went to zero, well, they can only go up from here. And of course, 15 years later, they did. But for 15 years, it didn't. And there was a time when we were the only one of the few places in the developed world that actually had positive bond rates. Like Europe, Japan had negative rates. So when you think like, well, it can't go below zero, well, actually it could. It actually could go below zero. And that was a crazy time. But there was an article, I wrote a blog post about this many years, I think it was 2017. It was hilarious. There was the article was based on an article, I think it was out of the Netherlands. And there was a company, it's a small business that actually borrowed money at negative rates as a business. So they actually got paid to take somebody's money. And it was the business was kind of one of those questionable businesses, which made it funny, which is why they did the article. But the fact that they would actually loan money at a negative rate was like, well, how much are you going to borrow? I don't know. How much are you going to give me? I'll take it all, yeah. Right? You're going to pay me to take your money? Sure. Give me as much as you got in your vault. You know, I don't know what I'm going to do with it, but we'll figure it out. So, you know, when you always think there's like, well, it couldn't go lower. Well, it did. And of course that got people scared because they're like, well, where's the bottom? And then you're just like, and at that point, it's like, okay, now we got trouble, right? Like how low can it go? So it's always a question of when you're making tactical is you have to make a executive decision, and that's where the challenge comes. That's where the mental gymnastics go in your head as to what do I do and what's the risk to reward. So Megan, I want to ask you as we wrap it up here, like how do you think about that when you're thinking about portfolios? Because there is an element of tactical in everything. It's who's making the decisions ultimately important. So how do you generally think about that?
Generally think about, I'm sorry, I'm not following the question here because I'm not a tactical person. So
all right. So I guess my point was when we're talking about this the small sliver of difference between tactical and allocation. Even allocators are making tactical decisions from time to time. So, how do you police that within yourself so that you have a process, or at least some way to dictate, like, I'm making a good decision with this, even a small tactical decision, still technically tactical. So how do you think about that?
Yeah, I mean, look, I think a lot of it comes down to due diligence, right? And really understanding what you're invested in. In my firm, we don't just immediately shift to a new fund or a new holding. It has to go through a rigorous process of understanding what we're trying to achieve and allocating in that space. What is the investment universe choices, interviewing and doing due diligence with a number of managers, and then finally making a decision to deploy. So why I say that is, I think form and structure and process is incredibly important. And what I would also tell you is I'm client facing, right? So my investment team, they're not direct client facing, right? I mean, they meet with clients with me, but they are not engaged with the client like I am. And when you have a client experience and you're directly engaged, emotion kicks in and you do want the client to be happy. So one of the things I respect about my investment team is they are not swayed by anything. I can't get the process to move fast, to move slow, to change. They follow their process, and they're not going to change, switch up their knitting just because we want to make a client happy. It has to be the right thing from an investment standpoint. So that's probably the best way for me to explain how we handle that type of potential issue in the portfolio.
Cool. So as we kind of wrap it up here, Megan, final thoughts, where can people find more about you?
Yeah, I mean, I think the thing is, just know who you are as an investor. I know I believe in diversification. It is not fun. Trust me, last year, things like real assets were a real difficult area to have clients in. But I think it's looking at the performance long term. So I think if you're going to have a lot of process and know who you are as an investor, make sure you are getting the right type of performance reporting so that you can track it over the long term. Short-term performance, something that's a year, 2 years, that's not really telling you what's going on in the portfolio. But when you can have 5, 6, 7, 10 years of how that portfolio is performed in different markets and be able to benchmark it and look at it net of cost, that's where you're getting really valuable data that you can integrate into your other financial planning. So I'm Megan Gorman. You can find me at All the President's Money on Instagram. Kirk, thanks for having me on.
Thanks for coming on, Megan. And Phil, final thoughts from you.
So I agree with Megan about process and also long term. And the story that I love to tell that I haven't told in a long time is, if anybody remembers Bill Miller, he managed a fund for Legg Mason that was the best performing fund for years. And he used to tell a story about how when he was early in his career and he was looking for a job, he went in and he's presenting these stocks. And the managers looked at them and said, "These look great, but I can't buy them now." And the reason they couldn't buy them is because their performance had not been good. And these were stocks that were being bought for the long term. So the idea there was, and Bill Miller's response to them was basically, well, if you bought these stocks 5 years ago, or stocks like this, you wouldn't be in this situation now. So it's important that not only do you have process, but to me, at least from the way I invest, I also want to make sure you think long term, because anything can happen over the short term. I always tell people when they ask me, like, what do you think the market's going to do? Well, I'll start with, my crystal ball is both cracked and cloudy. I don't know. And there's no way that I can, because there's so many factors that get in the way. So have a process, have a long-term focus. I think those are the two most important parts of investing discipline, and know who you are and how you're going to invest within that. As for me, at my firm, I work with women experiencing big life transitions, which I know can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. You can download my free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for my blog. Thanks for having me today, Kirk.
Great. Thanks for on, Phil. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.